Okay, so good morning and welcome back to another fresh session on credit risk modeling. And so we'll just take it up from the point where we had left it off yesterday, right? So basically, we'll start talking today about most. So yesterday we had been talking about the behavior scorecard side of things. So in yesterday's discussion, following on the important points which we had discussed. Point one was that where is the or how is it that the behavior scorecard is used. That's one. The second is that what are the important variables which are used to capture the willingness of a borrower to pay. What is the dependent variable? What is the most important? What is the dependent of the target variable? Then what we went to see was that what was the risk drivers and how is it that the behavior scorecard can be used to take up multiple business decisions, right? So these are the concepts which we had discussed in the last class. So we'll take it up from there today. So basically, till now we have been talking about mostly we talked about credit cards as a business product, right? So credit card or the revolving retail products. So we have seen that the entire portfolio of a borrower is divided into entire a portfolio divided into parts. One is I mean, any business lending or any bank's portfolio divided into parts. One is the commercial, the other is the retail, right? And within that part, what we have is the credit. So, in the retail portion, there are three sub portfolios. One being the qualifying revolving retail exposures, which comprises of revolving products like credit cards, overdrafts, etc. On the other hand, what we have is we have different characteristics. So we have uh, things like we have or we would be seeing up things like uh, credit cards. We will be seeing up things like so basically within the retail portfolio there were three sub portfolios. One being the qualifying revolving retail exposure, which comprises revolving products like credit cards and overdrafts. Then what we have is the next part, which is you know mortgages, and then we have other retail products, which comprises products like uh, personal loans, auto loans, etc. So over here we have discussed about about credit card as a business product. We had an overview about it, and after that, the next thing that we talked about, or the next thing that we brought into, was the application scorecards, or how is it? What are the key sources of risk at origination for a credit card? And what are the origination and what are the source of risk for the for credit cards at the account management stage. So these are the two important things that we had explored till now for one product, the credit cards. And in respect of that, we have also checked that what are the you know what is origination, and then we had checked for account management as well. Also, we have checked the respective segmentation or respective factors across which the riskiness in a portfolio might vary, right? So these are some of the important factors. These are some of the important things that we have looked into, right? So in this respect, there are some important factors. There are some important things that we need to look that talking about credit cards, there are a few important factors that we need to keep in mind going forward as a business person or as a person who has worked with credit cards should know the following. First is they must know the on an average what are the number of accounts that are there on the books of a bank. Basically, if I am actually consulting a bank on something, right, so then then I must be aware of the number of accounts which are there on the books of the bank. So how many accounts generally are there? So this is a very typical business question that we have that, okay, so of the product that you work with, how much of or what has been the total number of accounts, the total number of bookings the bank has had at a given month. So this is one very important part. The second part that we need to remember is about the receivables. So what exactly is the receivables which a credit card portfolio has, or the credit card portfolio for typical bank with which you have worked with has. So there are the number of observations, there is a number of receivables, right? The next part that I have over here is something else. So the next part that we'll talk about here is the bad rate. So what exactly is the bad rate across the portfolio, right? So these are the three important matrices that we need to keep in mind for credit card as a product. So this is a very important part, or you can say these are some very key portfolio matrices about uh, about credit card as a business product, right? This is what I can call the three basic portfolio matrices. Key portfolio matrices. About the key portfolio matrices. Now, apart from this, there are also other, other key portfolio matrices or other portfolio matrices such as the bad rate across the buckets. So basically, how are the buckets or how are the bad rate across the buckets varying in nature, right? So how would you so as I move from bucket, the non-delinquent bucket to the first regular delinquency, how are the bad rates distributed? So what are the average balances held by these buckets on a month-on-month basis, and so on. So there are these different kinds of things that are there, right? So these are very key portfolio matrices. So if you have worked with banks and if you have a history of working with banks, try to know that what are these key matrices, because in any interview, right? So when they try to understand whether you have worked on a project or not, they do not ask you generic technical questions, because technical questions is something which someone would be able to defend if they have had a theoretical training. The part which they would not be able to defend in that case would be the part where you do not have all these matrices, and where you would not be having these it would not be possible for you to have information on these business matrices. So if you have not worked on a project, so if you know what is like how many borrowers are there, what is the average receivables, so on, just put it out to them, right? I can tell you about the overall bad rate on the number of accounts. So basically, uh, a bank for a large bank, right? Uh, the credit card would be the number of accounts would anywhere range between 3 million to 4 million on a given month, right? And the overall bad rate is anywhere between 5 to 10%, right? So mostly it's around 7 to 8% on the whole, right? So if you have 3 million and 7 to 8% of that is a huge number. Therefore, this is mostly, and the receivables depend on the limit, right? So basically, what you can do is you can look into, you can take a bank, right? Look into the different products that it has and the different type of portfolio matrices that it has. I mean, the receivables that are there, or the limit that particular person has, and you can actually look into that and try to understand that how good or how bad the like what exactly is the distribution of the limits across, and from there you can find out the total receivables. The total receivables is nothing but the limit into the number of accounts having the limit summed over all the values of the limits, right? So that is the total receivables. The total receivables is the sorry, total receivables is the sum of the total usage that has been done on a card in a given cycle in the immediately preceding cycle, and where you have overall receivable, right? So this is what the idea is. So obviously, what you need to do is when you are trying to create your understanding of a credit card as a business product, the best way to do is just try visiting the websites of different banks, right? Mid-sized banks, small-sized banks, international banks, and so on, and try to frame an idea that how do they operate in terms of their products, right? And what are the different products that different banks have to offer, and then from there you just try to understand that okay, well, what are the pros and cons of these products, which can be, so that gives you a better understanding of the credit product that the banks are actually offering, right? So this is something which, this is one exercise which you can do. You can go into banks like the websites of banks like Citibank, HSBC. You go to American Express for cards. They are one of the market leaders, right? Then you can go into other banks like Citibank. Having said that, you can go to Bank of America, or you can go to any other Islamic bank, say Abu Dhabi Bank, and etc. And you can compare products across regions, across areas, right? Or depending on the type of product that each of the banks are offering, what is the type of salary limit that they are looking into, and whatever. So how is it that you can actually assess that which is a more premier product, which is a more a basic product, and how do you do that? So this is something which is a really interesting stuff, because if you want to get an idea about the product, it is always better to look into the product which the bank has to offer on their website. So this is a practice which you can do. Now, these are some of the portfolio matrices, right? Now, another set of important matrices is your origination matrices. The matrices, the important matrices which you get to see at origination. So, what happens at origination? So, at origination, what you are trying to do is you are just trying to book the customers, right? So there is this origination. Now, in origination, what we are trying to do is we are trying to look into the, or whenever we are trying to summarize the portfolio at origination, our objective is to understand that how is it that we can, you know, how is it that we can represent the portfolio of the origination on a month on month basis? How many borrowers are being acquired? How many persons are being done? So at origination, the most important matrices that we have are the number of bookings, the number of bookings which is done. The next part is the limit book.
I wanted to ask, the matrices that you pointed out before were account management matrices.
No, these are portfolio matrices. So they
Okay.
summarize your portfolio. So if I want to determine my credit card portfolio, I would be looking into these matrices. Now, if I want to understand my origination portfolio, now what is the difference between origination and the portfolio matrices? So the overall portfolio matrices will give me an idea about what? It will give me an idea about the fact that uh, that how is my portfolio behaving, say up to date. So this, say last month I had 100 acquisitions, this month I had 50 acquisitions. So the portfolio matrices for this month will be 150. So it will give me the cumulative number of accounts, right? Whereas origination matrices will give me the number of accounts which has been acquired on the books of the bank as on that or as on that month. So this is the origination portfolio. At origination, how does the portfolio look like? So how does the bookings look like over the last 3 months, last 6 months, 9 months, 12 months? How is it that the limits booked look like? What has been the average number? What has been the average limit which has been booked? What has been the number of average number of bookings which are done, and so on, right? So these are the different kind of things that are there. So over here, when I talk about origination portfolio, obviously one of the important part is the limits book. Then the next part is average limits. Average limits, right? So there are these different kind of, so there are these different matrices which are there. Like then from here you can find out average bookings last 3 months. Bookings last 3 months. Last 3 months, right? Average booking last 6 months, last 9 months, like this. So you can actually keep on looking into these averages over different metrics, the amount of limit that has been booked. Now within that, about the number of bookings and in the limits booked, what you can look into is that how much of this limit which was booked, say 12 months ago, how much of the limit is standing in the current bucket, how much is standing in the delinquent bucket, and so on. Also, what you can look into is say how much of this limit that book has happened to the relationship segment, how much has happened to the non-relationship segment. Now with the non-relationship segment, how much has come through the third party sales channel and how much has come through the banking channel. Now then out of those, you can look into that out of the total limit which has been booked through the banking channels, how many of them are delinquent and what is the distribution of the delinquency buckets now. Similarly, what you can do is for the third party sales channel, you can have a bucket wise distribution of the delinquency factors. So it is this way that this entire framework actually works, right? So with this, so these are different matrices through which you can actually frame an idea about how your portfolio has been, how has your portfolio been working. You can try to obtain insights about the portfolio, right? So after this is done, right, so we'll talk about, so with this we come more or less close on a discussion on credit cards, right? Now after this, the next part that we need to talk about over here is uh, the next thing that we talk about over here is the second type of revolving products, which is nothing but the ODs or the overdrafts. Overdrafts. So what are overdrafts? Overdrafts are nothing but it's a current account facility. It is nothing but a current account facility. It's a current account facility. So what type of a facility is it? So under this current account facility, what we can do is we can do the following. We can actually use this current account. So basically in overdraft what happens is, let's say suppose I in a savings account I can draw up to the amount which I have in my bank. Right? I can draw balance up to the amount which I have in my bank. If I do not have it, I cannot draw it. So, however, in an overdraft facility, the overdraft facility helps me draw an amount which is more than what is in my bank account. So, if in my bank account I have say 10,000 rupees, but I require 15,000 rupees, and my overdraft limit is 20,000, then what I can do is I can simply draw out 5,000 more rupees. So, this 5,000 rupees is extended out to me as a loan uh, to be repaid back within a given period of time. So this overdraft facility, it is actually again a revolving product, because in the sense that there is a limit to which I can draw the funds, but I can actually draw the funds, and then I can draw up to that limit. I can exhaust my overdraft limit, and then until and unless I pay back some amount, my limits are not released or freed up, and hence I cannot take that up, and hence I cannot, uh, you know, take it up for uh, take it up for further usage. So this is where this role of overdraft actually comes in. So overdraft forms a part of a current account facility. Now, understanding this concept of overdraft is really important, because this overdraft or the existence of a current account facility becomes a very important factor when we are dealing with personal loan model development or model development of such closed-end products. Right. So this is a very good risk differentiator going forward. So as we see that overdraft facility is or has a very distinct risk differentiator. So how this is a good risk differentiator? What exactly this product is? So these are something that we would be talking about today, right? So mostly. Uh, the behavior as well as at the acquisition stages, we'll have similar kind of modeling experience or very similar kind of modeling framework. And I'll just talk about some of the few variables that are there, which is really very important. So an overdraft is nothing but it's a current account, or as some geographies call it, it's the checking account portfolio, right? So it is a current account or a checking account portfolio. It's a current account or a checking account. So what is a current account? So a current account is one which helps me, uh, uh, so which helps me by allowing me to overdraw money from my account, right? So it helps us to draw out more money, or it's a kind of so it's an account from where loan can be taken. It's an account from where loans can be taken. Loans can be taken. Right. And one very specific type of a current account is overdraft. So very much like a credit card, right? An overdraft has a limit and a balance. But the very fundamental difference with a credit card, fundamental difference between overdraft and a credit card is that there are two differences, So basically, on a credit card, you may not have the facility of drawing a cash. You do not have the facility of drawing, taking up or making a cash withdrawal. So all you can do is you can ideally, you know, buy goods using credit card, even though some credit card has a cash advance facility. However, that is not a mandatory facility to be given to someone. So therefore, the account from where loans can be taken. So basically, when I talk about an overdraft is also a very similar revolving product, but it is used for borrowing funds, whereas credit card is used for borrowing these for borrowing money and purchasing goods and services. You may or may not withdraw cash, but using overdraft you are actually withdrawing direct funds or cash. So that is where the basic difference between overdraft and with credit card is, right? So having said that, so the two most important component of a credit of a overdraft is again the balance and the limit. balance and the limit. So there are these two things over there, right? So one is balance and the other is limit. Now, what is the limit? The limit is the approved amount of limit or the overdraft limit. Approved OD limit. So basically, approved OD limit is the amount of limit which has been approved by the bank for you to draw the money. So basically, the bank allows you a overdraft amount of 20,000. So that is apart from the funds that are available with you, you can make a withdrawal of extra 20,000 rupees, right? So that is the approved limit that the bank has. I mean the approved limit that that is there. Now the second part that I have over here is balance. Balance is the balance outstanding or the amount outstanding on the books of the bank for this credit card. This is the amount outstanding. So what is this amount outstanding over here? So basically what happens is if I have a balance over here, right? So this for this balance that I have is the, say for example my limit is 20,000, but what I have done is I have withdrawn 8,000 rupees. So the amount outstanding on that overdraft account is 8,000, right? So this is what I have over here. Now within this limit, with this applicable limit or this approved limit, there are two parts to this. One is a observed limit or a known limit that you have, which you can actually. One is the observed limit, and the second limit that I get to see is one is an observed limit, and the other that I get to see is the shadow limit. Other is the one is the observed limit, and the second that I have over here is called the shadow limit. Now, having said that, so what is the observed limit? So the observed limit is the limit which you know, right? Say they tell you that your limit is 20,000. So you know that you can draw up to 20k. But also you are given a shadow limit which you are not generally aware of. So you have a shadow limit of extra 20,000, so which makes your total limit of 30k. Right. So this shadow limit that is over here is not generally known to the borrower. So this is generally unknown and means it is called the shadow. Right. So over here, what I have is I have the observed limit, I have the shadow limit, and from there, what we have is we have this. So be it the shadow or the observed limit, every bit of this product comes out with a limit per se. Now, the shadow limit is generally kept there for very high end and high usage customers, right? So customers who are actually using, who use credit day in, day out, and they pay back because they are business people. So, for them, what we do is we use this. For them, the shadow limit is there. Now it is generally seen that accounts which it is not, again, it is not necessary that every credit overdraft product will have a shadow limit. So you can just come up with only the observed limit as well. So you know that that is the limit of the card. Now accounts which have shadow limit, right, are charged differential rates of interest. Say for up to observed limit the rate of interest is R1. Right. So for this shadow limit, what we have is R2%, where R2 is greater than R2 is strictly greater than R1. Right. So given this particular behavior, what we can say is that yes, or given this particular thing, we can say that 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 up to observed limit the banks charge at a given rate of interest, and from the observed to the shadow limit within this difference, it is that that difference of that excess the added amount is charged at a higher rate of interest, right? So this is something that we need to understand, or this is something that should be very clearly understood at this point. Now, based on the balance and on the limits, or using the balance and limits, we can identify two types of overdrafts, or types of overdraft users. One is authorized overdrafts. Now, whether it's authorized or unauthorized overdraft, so that is a very specific case. Okay, so there is a authorized overdraft, and the other is an unauthorized overdraft, depending on whether you have the facility or not. Unauthorized overdraft. So now when I talk about authorized overdraft, so what is an authorized overdraft? So an authorized overdraft is nothing but where you are actually using an overdraft facility. So you have a current account, right? And you have the authorized facility. You had applied for an overdraft and that has been actually given to you. So there are again acquisition strategies relating to overdrafts. So this, so that is an authorized overdraft. So where you have a current account, right, and you have applied for a current account authorized facility or overdraft facility, and you have been given, or you have been granted that access, or you have been granted that authorized, or the authorization to use the overdraft. So that is your authorized overdraft. Now coming to the next part is your unauthorized overdraft. So the unauthorized overdraft that I have over here is that you have a current account, but you have not been given the authority to use the overdraft, but still you use the overdraft. So that is where it's an unauthorized facility, and unauthorized overdrafts come with added interest cost, right? So there are these two different things, and they pose different. And these two have different kind of schemes, and they both,
Uh,
yeah.
I have a question. Yes, if the person is unauthorized to use the overdraft limit, then how would he manage to use it?
See,
I
there
mean, how
are,
would he figure
yeah.
out?
So that is basically, see, there are different kind of products, right? So one in one case, you do not, you have not applied for the authority, but you are overdrawing from your current account, because a current account generally allows you to do that, right? But you do not have you do not have an overdraft facility associated with it. So in that case, you are an unauthorized overdraft, and you are generally charged at a higher rates. So with overdrafts, with authorized overdrafts, you come with different kinds of facilities, or you come with different kind of permissions to overdraw up to a limited account, or up to a limited you know facility. Say for example, I have a current account, right? So in Middle East and UK, most of the salary accounts are current accounts. Now what happens is that I have only 10 rupees left in my facility, or in my account, but or 10 pounds left, and the transaction that I want to make is 20 pounds. So when I talk about, when I look into this, right, what happens is I will just so I just swipe my card. The transaction of 20 rupees happens, but I do not have an authorized facility. Therefore, I will be charged at a higher rate of interest. You know that there are certain credit cards which allow you to overshoot your limit, but once you overshoot your limit, your card gets blocked, and that overshot limit is charged at a higher rate of interest. And there are some credit cards which will not allow you to make that transaction if you do not have the sufficient balance left with you. So there are these different kinds of products, right? So I'm just talking about just two kinds of product. It is not always that an overdraft or a current account will allow you to use overdraft, and in that case, if you do not have a facility, you cannot use overdrafts as well. But there are current accounts which can actually help you, or which would help you do the transaction. But you have, once you overshot the balance that is there in your account, that added amount is charged at a very high rate of interest. So that is another way. But after that a transaction has happened, you are not allowed to make any more transaction on that particular account until that amount has been repaid. Whereas for authorized overdrafts, up to a certain limit, you can actually go about making a payment, right? So these are by the virtues of the product, the way the products are designed. I'm just talking about two possibilities. Okay, great. Okay, great. So what is an authorized overdraft, or how do I identify what an authorized overdraft is? So for to identify an authorized overdraft, so we need to look into the balance. So obviously one very important part is that for an authorized overdraft, the limit will be greater than zero. So obviously this guy who has this overdraft facility will be given a balance, or will be given a credit which is greater than zero, right? So this is the first characteristic of authorized overdraft. The next part that I have over here is the unauthorized overdraft. Authorized overdraft. So for unauthorized overdrafts, the limits will either be zero, so either it will be set to zero, or the limits will be missing. Right? So there is authorized overdraft, so the limit is greater than zero. The second is unauthorized overdraft, where the limit is equal to zero, or the limit is missing. Right? Now this unauthorized,
Okay.
so the authorized overdraft,
Okay. Sorry.
yeah, yeah, you want to
So,
ask
and
me?
we check the, yes, yes. Yes, I want to know that,
Uh,
and we check these limits in the database column
Correct.
for a customer, right?
Correct. So basically, if limit is a given variable to identify authorized overdrafts, I would look into those variables where the limit is greater than zero and the balance is also greater than zero, right? And in unauthorized overdrafts, the limit is either zero or missing, but the balance is but the balance is greater than zero. So these are all the authorized overdrafts. I mean, so these are basically, so this is basically what overdraft would look like, right? So these are two possible facilities which are generally seen. However, there is always a method that so there can be banks who do not allow any kind of unauthorized overdraft to be held to happen, right? So, so this is something which is there. Now, the next part that I have is that with authorized and unauthorized overdrafts, which are considered to be more risky. Obviously, unauthorized overdrafts are generally considered to be more risky. The first thing is, why are they more risky? Now, to understand that, what you need to know is that whether the person had applied for overdraft facility or not. So, if your account had applied for an overdraft facility in that account and was rejected that thing, it means that this guy does not is not financially stable or is not financially capable of maintaining this particular thing, right? On the other hand, what we have is the unauthorized for the unauthorized overdraft. What we also need to know is the huge amount of things, you know, uh, what should I say? That unauthorized overdrafts for unauthorized overdraft, what we need to know is that a person was not given the loan because he did not have the capability to pay the loan. Right? That is why he was rejected that overdraft facility on his current account. Right. Now, however, if he's using the balance or if he goes, if he overdraws his funds, it means that the exposure is relatively risky to banks compared to people who have authorized facility or authorized current account or overdraft facilities. Now, having said that, the next part that we talk about is uh, okay. So after this overdraft question, uh, yes. So the next part that we'll go into is to talk about the different kind of current account balances and their respective risks, right? And this existence of account with current account or with overdrafts is itself a very important risk differentiator at acquisition stage for multiple products, right? Say for example, I am trying to model the acquisition behavior of a borrower for a personal loan. So, what I'm trying to do is I'm trying to model the acquisition behavior for personal loan. Shouldn't be here for personal loan. So how is the acquisition or how should a customer be or borrower be acquired on the books of the bank? So over there, what I'm trying to look into is acquisition for person. Right. So when I talk about acquisition for personal loan, what happens? Uh, so over there, the concept of this overdraft and non-overdraft segments become very prominent. So OD and non-OD segments are really very critical at that point of time. OD and the non-OD segments become really very important at this stage. The reason being over here that so let us understand first of all that how is it that the acquisition behavior and so the acquisition behavior of a personal loan and the ways of model development or I mean and the and considering the OD and non-OD segments within those models, right? So how does OD, non-OD and personal loan correlate with each other? How is it that overdraft segments or over the existence of overdraft and non-overdraft facilities, how is it that it impacts the chances of being a good or a bad borrower for personal loans or for other loan portfolios, right? Okay. So, so before I move on, Harpreet, there's a quick question for you. That how do you think? So when I'm trying to model the acquisition behavior of a borrower for a personal loan, so I'm trying to decide whether I should be giving him a loan or not. And in this case, how do I know whether OD and non-OD segment? So how do you think this concept of overdraft and non-overdraft? Uh, so basically, whether a borrower owns an overdraft or he does not own an overdraft, how would it impact the acquisition probabilities of a personal loan for that borrower?
So first we'll check the limit of the overdraft. If he owns the overdraft, what is the limit? That means he has the paying capability of that overdraft.
Okay.
Secondly, we'll see if he's able to pay back the amount that has been overdrafted with time.
So how
And
would it
also
relate
we'll
to the personal loans? So I'm trying to develop an acquisition model for the personal loan. Okay. So you have applied for
okay.
personal loan. Now, what the bank looks into is whether you have an overdraft or non-overdraft, or you do not have. So whether you
Okay.
have an overdraft or you do not have an overdraft, and the bank considers that as a criteria for giving you a loan or not. Why would the bank do so?
Because overdraft was kind of a personal loan, small personal loan, which the
No,
person has been
no.
using from time.
Personal loan
No.
is a closed-end product, and overdraft is a revolving product. So the two are not the same.
Okay. Okay.
Okay, so basically, I'll just tell you the answer.
Okay.
Hmm. So let's see. Uh, uh, so suppose I go and ask for a personal loan from a bank. Okay. Now, when I ask for a personal loan from a bank, what the bank does is the bank looks into the why would a bank look into the current account status, the OD or whether a person owns an overdraft or they do not own an overdraft. The reason is, say suppose I am given a personal loan and I am a guy who has an overdraft. Now what I do is I take money from the overdraft, I pay off my personal loan, and then I default on my overdraft. Because for the bank, if an account defaults on an overdraft, that is more risky because the rate of interest on an overdraft is much higher. Therefore, the exposure to the bank is much higher. On the other hand, a borrower who does not have an overdraft will not have the option of like using that to pay off a personal loan. And the idea over here is that overdrafts are generally done and generally have very high limits. And to some extent they have limits where which covers up the the amount of personal loan that I need to pay. So I might just go ahead and default on the personal loan, but I might what I might do is I might also uh, I might just go and pay back the personal loan by drawing money from the overdraft, but I may default on the overdraft. Hence, borrowers having a overdraft facility are already existent historically is considered to be more risky than a borrower who does not have such a product, right? So this is precisely the reason as to why overdraft and non-overdraft ownership becomes an important segmentation variable for the dependent for the variables. I mean, for acquisition of acquisition certain credit products, right? Great. Okay. So basically, and that is the reason why when we talk about personal loan model development as well, we see that this current account status of a borrower becomes very important. Okay. Okay. So basically, when someone is actually trying to acquire a customer on books, say for personal loans or for any such products, right? Uh, what happens is we look into the current account status, or as we call the checking account status. Now, current account is called as checking account in different countries, different geographies, right? This is mainly a European term. So what we have over here is a checking account. So now over here, within the checking account status, there can be two ways. So one possibility is that a person may have a current account, yes and a no. So the borrowers who do not have a current account or do not have any kind of a checking account, be it a, you know, so uh, so in checking account, obviously, so if a borrower does not have a checking account, that is, he does not have any form of a current account, then that is perhaps the best possible thing that can be. So he is the safest customer, or he is, or the borrower without any current account is considered or is always considered to be a low risk borrower. And those who have a current account are considered to be a high risk customer. Right? So the borrower over here is a high risk borrower. Now, within this high risk borrower, there will be a relative distribution of riskiness. And what is that? The relative distribution of riskiness that we can see over here are borrowers who have thoroughly maintained current account balance as negative. So, borrowers who always have had a negative current account balance, and borrowers who have a current account balance but always maintain a positive current account balance. So the first case over here that I can see is that this is overdrawn, right? So this is a case where the balance or this person, is overdrawn. So basically, if a borrower historically maintains an overdrawn current account, what it means is that this guy can actually take up or has the tendency to take up a loan and not really pay it back. So that means this borrower is inherently a risky borrower because he is actually overdrawn on his current accounts. So, so if a borrower is overdrawn has an overdrawn current account balance, then he is always treated to be a relatively more risky borrower than the others. Right? So balances or borrowers who have overdrawn current account balances are considered to be the most high risk borrowers. Now, within this high risk segment of borrowers with current account, those who have or those who maintain negative current account balances are high risk borrowers. Whereas borrowers who do not maintain this negative current account balance, so for them it is, so this is a low risk segment. This is a low risk segment. Right? So among the high risk, this segment with negative current account balance is a more high risk segment, and the one with balance greater than zero is a low risk segment. Clear? Great. So even when we are developing products, say for mostly for personal loans, right, we are always looking into the current account behavior, or we investigate the current account behavior, and based on that we try to develop the products from there. Now now talking about overdrafts, and since we have been talking about this, so let us understand that what are the most important variables or key variables which are required, or which we need to know for model development. Now, one obviously, yes, so some important variables. So within important variables, the one very important thing that we need to know is, so obviously, yes, limit is one of the variables, right? So we always need to know the upper limit, right? So if the person has a observed and a shadow limit, then it is the shadow limit that we need to know. So it's the higher limit that we need to assess, right? Now, one very important thing is that while we are talking about these basic variables like the limit and the balance, limit and the balance, these are very critical variables. First I might have limit, then I have balance. Now after balance, what I'll have is interest rates. So we have the interest rates, right? So after this, after interest rates, then there is late fines, right? So these are some important variables which we need to have in, or for developing a credit, for developing a current account model. And while we are trying to develop the current account model, obviously, yes, we need to ensure that most of these variables, or that these variables should have a proper quality, right? So for each of these variables, or each of these core variables, what we need to know is that each of these variables must have a suitable quality. So the data quality checks for these group of variables has to be done in a very proper manner, right? So the data quality for each of these variables need to be checked. And what do I mean by the data quality over here? So what I mean is that for most of these uh, variables, right, of all of these variables, there must be no missing values. There must be no abnormal trends, and there must be no, uh, you know, so there must be no abnormal trend in the frequency distribution or in the univariate measures, right? So, and this, so whenever, say, basically when we talk about developing a personal loans developer model, be it acquisition or be it at the behavioral stage, or we are talking about developing a BD model, or we are talking about developing a, a behavior scorecard or such like that. What we are trying to do is we not only include that product, we not include that the variable of those products, but we also include the variables from current account if a particular person holds a current account, because as we have discussed, this current account variable has a very important implications for this part. It has really very important implications for this for these products. So the variables from the current account are included. The variables from the personal loans or behavior is included, and then either you create two segments out using the current account, or these variables be included in order to find out, or these variables be included uh, within the modeling as explanatory variables. So there are these different variables which are there. Clear, Harpreet? Any question up to this point?
Clear. No questions as of now. I think I'll go through it again and
Okay.
then I'll be.
Okay, great. So for this, you can refer to the Investopedia site. Okay, so
Okay.
both for credit cards as well as overdrafts and current accounts, you can refer to Investopedia, which will give you a very detailed description of the different products. Right?
Okay.
Okay, great. Okay, so the next product that we'll start talking about is, so with this we come to the end of the revolving products, right? Now the variables like utilization, which we had discussed for credit card, also applies in this case, right? And over there you have a limit, you have this balance, so the balance by the limit by the balance will get your thing. Then again you have your payment ratio, payment balance ratio, so how frequently is the particular person paying back. Then a variable like date since last payment is very important. Again, yes, I missed out on it. One of the very important variables of this variable will be the delinquency on this particular product. So if a particular person has a current account, and he has been delinquent on the current account historically, then that historical delinquency is really something which is very important while deciding whether to give this guy a loan or not. So at acquisitions, delinquency, the historical delinquency of the borrower on this on the current account is something which is really important, right? Okay, so the next part that we need to talk about is, or the next part that we start talking about is the closed-ended products, right? And the product with which we start off is, so with this part we have completed, or we have more or less covered our QRRE, that is the qualifying revolving retail exposure. So basically, this is a retail portfolio. This is a retail revolving portfolio that we have discussed right under Basel. So basically, if I think about it in terms of the Basel framework, these groups of products are placed under the QRRE sub portfolio, which is nothing but the qualifying revolving retail exposures. The qualifying revolving retail exposures. So this is something which you can check upon the Basel website, the PIS website. And after this, there are to complete the the retail portfolio. There are two broad groups of products. One is your, one of them is, so one of these particular products that we have over here is mortgages, and the next group of product that we have is the other retails. So the other retail products are the products which are the closed-ended products and comprises of secured and unsecured lending, like personal loans, automobile loans, etc. Right. So this is something that we would take up next. Right. So today let's stop here for the day. Tomorrow we start talking about personal loans, and when we bring in personal loans, that is where we bring in both the relevance of the credit card product as well as for of the current account in modeling personal loans. So how do these revolve, the existence of revolving products impact personal loan? That is what we see. So we have introduced the concept of this today, that why at an acquisition stage of PL, why do we use
Hello.
OD and non-OD. Tomorrow's session we'll talk about the personal loans. Hello?
Hello. Your
Hello?
voice
Hello?
just broke in between.
Yeah, can you hear me now?
Hello.
Hello?
Yes. Yes.
Yeah, okay. 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 So tomorrow 7:30. Happy
Yes. Okay.
Good Friday tomorrow. Okay? Great.
Yes. Yes. Okay.
Great.
Bye bye.
Bye bye.